I'm Elizabeth Warren, Chair of the Congressional Oversight Panel. I'm here to introduce our August report, The Global Context and International Effects of the TARP. The financial crisis that peaked in 2008 began one mortgage at a time here in the United States. Millions of people, attracted by the prospect of homeownership or refinancing and low initial rates, signed mortgages that they could afford only so long as home prices continued to rise. When the housing market collapsed, many borrowers faced foreclosure, and many investors faced staggering losses. In an earlier era, a mortgage crisis that began in a few regions in the United States might have ended there as well. But by 2008, the global financial system had grown deeply internationalized and interconnected. Mortgages signed in Florida, California, and Arizona had been bundled, sliced and diced, sold and resold to banks and other investors in New York, London, and Tokyo. At the same time, new financial products had migrated around the world, adding fuel to housing booms in other countries. In essence, around the globe, banks had built the same business model on the same flimsy foundation of risky mortgages. When the foundation collapsed, the result was a truly global crisis. Into this nightmare, many national governments intervened. One of the main components of the U.S. response was the $700 billion Troubled Assets Relief Program. TARP's approach was to flood money into as many American banks as possible, including those that had major overseas operations. As it turned out, this approach made the U.S. unique. Other nations targeted their rescue much more narrowly, rescuing only a small number of banks that typically had few U.S. operations. In the end, the U.S. pumped capital into more than 700 banks, while all other G8 nations combined reached fewer than 50 banks. The result appears to be that America's rescue had a much greater impact on other nations than their rescue programs had on the United States. Now, this may have been inevitable given the structure of the TARP, but if the U.S. had gathered more information about the flow of rescue funds, it could have asked other countries to share the pain. Banks in France and Germany received billions from AIG's rescue, yet the U.S. bore the whole $70 billion risk of the AIG capital injection program alone. The American share of this one rescue was twice as large as France's entire capital injection program and nearly half the size of Germany's. Looking back, it is difficult to measure the exact extent of TARP's international impact because Treasury never monitored where TARP funds went, including whether they went overseas. This is unfortunate because without good information, it is hard to make good decisions. Now, this is partly a criticism of the inadequacy of day-to-day data collection, particularly in the international area. And it is partly a criticism of the failure to force the banks receiving extraordinary help to collect and report information on where that money is going. The crisis also underscored the lack of any clear international plan for responding to financial emergencies. Congress required Treasury to coordinate its efforts with other nations, which it did. Even so, the global rescue unfolded on an ad hoc, informal, country-by-country basis. Each government made its own decisions based on what was best for its own banking sector and its own economy. This ad hoc approach ultimately restored a measure of stability to the international system, but it proved that the internationalization of the financial system has far outpaced the ability of national regulators to respond. In particular, the crisis revealed the need for an international plan to handle the collapse of banks so huge that no one nation can manage the fallout alone. Such a plan could have helped to avoid the chaos surrounding the collapse of Lehman Brothers and the rescue of AIG, which strained the international system to the breaking point and forced the U.S. to commit huge sums of taxpayer dollars to stabilize the system. It would also provide a plan of action if a crisis hit a very big, globally connected bank in a relatively small country. In this crisis, the Netherlands' rescue efforts totaled 39% of its nation's economy. Spain's rescue totaled 24%. It isn't hard to imagine that, without an international rescue plan, a future bank collapse could swamp the ability of its home nation to respond. Now, moving forward, it is also essential for the international community to gather more information about the financial system, to identify vulnerabilities, and to plan for emergency responses to a range of possible crises. To this end, U.S. regulators should encourage regular crisis planning and war gaming for the entire international financial system. To learn more and to read the full report, you can visit our website at cop.senate.gov. The world has faced many financial crises in the past, and we will undoubtedly face new crises in the future. Failure to plan ahead will only undermine efforts to safeguard our financial system. Careful policymakers should put plans in place before the next crisis, rather than responding ad hoc at the peak of the storm.